Okay, welcome everyone. This is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And for today's video here, I'll be discussing how you should be scaling up your trade size specifically for short naked option strategies. So that includes things like selling naked call options, naked puts, strangles, straddles, etc. And this is a very important topic because as your account size gets larger, as you have more and more capital to trade with, you're going to have to scale up your trade size to match your account value. And when it comes to naked options, there are two ways you can scale up, but they must be done in a specific order. So that's what I'll be showing you today. And very quickly here before we get started, for those of you who are new to the channel, I just want to let you know that I do also teach on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check those out, and when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. And so the stock we're going to look at in today's video here is going to be Pinterest. The reason being is because the implied volatility for the stock has spiked and is now at a pretty high level compared to where it usually is over the past year. Right, you can see both the IV rank and the IV percentile are both above 50%, and this is likely because earnings for this company are coming up very soon. But point being, with a spike in implied volatility, that means the options on this stock are going to be very expensive. And therefore, as an options seller, I would be very interested in selling these expensive options. So let's come over to the trade tab now and take a look at the option chain on Pinterest. And we'll go into the May expiration cycle here. And you know the drill. On the left-hand side, these are all the call options. On the right-hand side, these are all the puts. And then down the middle, you've got all the strike prices. So let's say for starters here, I wanted to sell a strangle on this stock. So perhaps I choose the 100 strike call option and the 65 strike put option. And because the delta on this put option here is greater than the delta on my call option, this strangle is leaning a bit bullish. And that's something I did intentionally because if you come back to the charts here, as you can see yesterday, Pinterest did have a very large sell-off. It went down by almost 10% in just one day. And given that my trades are often contrarian, meaning when stocks go down, I typically get long, and when stocks go up, I usually get short, that's why my strangle here is leaning a bit bullish. So let's go ahead and set up the order here. So I'm going to go to sell, and then go to strangle. And so as you can see down here, we're going to sell the 100 strike call option, and then also at the same time, we're going to sell the 65 strike put option. So right there. And let me scroll down just a bit here. There we go. So the total credit I would receive for putting on the strangle is $364. That's definitely pretty good. And again, that's because the options on Pinterest at the moment have inflated prices, which is a result from that spike in implied volatility. Now let's say though that $364 is not enough credit. Perhaps with time my account size has grown, and so now with a larger account size, perhaps I want to target around $600 to $700 in credit for any one trade. So this means, of course, I have to scale up this position. And like I said, there are two main ways I can do this. The first way is to simply double the contracts. Instead of selling one call option and one put option, I'll just sell two. So now that means my total credit for putting on the strangle is now double. So pulling up the calculator here, 364 times 2 is $728 in total credit. And that's what I'm shooting for. But there is a potential issue that comes with scaling up your trades using this method, just increasing the contract size. And specifically, I'm referring to the fact that I have now doubled my notional value on the trade. Notional value meaning what is the total value, what is the total dollar amount for this one position here? Well, in this case, because I'm now selling two call options and two put options, and each contract is tied to 100 shares of stock, that means my total position here is tied to 200 shares of stock, 200 shares of Pinterest. And in case you're wondering why it's not 400 shares of stock, that's because come the expiration day, only the call options or the put options can end up in the money, not both at the same time. So for example, come May 21st, if Pinterest explodes and ends up above $100 per share, above my call strike here, that means I'll have to sell 200 shares of Pinterest stock at a price of $100 per share. And then conversely, if Pinterest sells off and ends up below $65 per share by the expiration date, that means I'll have to purchase 200 shares of stock at a price of $65 per share. So given that right now, Pinterest is trading for 76 bucks per share, that means the total notional value of this position at the moment is 76 times 200, which is $15,200. That's a fair amount of money. And if, let's say, I had a $30,000 account, well, that means the notional value on this one position is worth half of my entire account value. And this amount can increase, right? Because if the stock price increases, the notional value is also going to increase with it. And in fact, in the worst case scenario, if Pinterest does explode, I could be liable for selling 200 shares of Pinterest at 100 bucks per share. So at that point, if I take 100 and multiply that by 200, if that were to happen, the notional value of my position would increase to $20,000. Not to mention, of course, I'm going to have many other positions on as well. So for example, if I have 10 other positions on, that means the total notional value of all my positions put together could be many multiples of my account value. If I'm not careful, I could be technically carrying $60,000, $70,000, $90,000 of notional value with a $30,000 account. Now perhaps most of the time that could be fine because most of the time stocks don't go crazy, but there is a thing called tail risk. And this is something you'll deal with on very rare occasions, like perhaps during major market corrections. But when those kinds of events happen and stocks do go crazy, you will face substantial, and I mean very, very substantial losses if you are carrying too much notional value for your account size. So in this case, if I wanted to scale up this Strangle here and not do so by increasing the contract size, then what I can do is scale up using the delta of these contracts. Basically sell options closer to where the stock is currently trading, which also means selling options with greater deltas, both on the call side and also on the put side here. So now if I decrease the contracts back down to one call and one put, and so now if instead of selling the 100 strike call option, I sell the 90 strike call, which is right there with a 27 delta, and then instead of the 65 strike put option, I sell the 70 strike put option right there. And let me highlight the 70 strike put option as well. And this one has a 32 delta. So now the total credit on this one Strangle is $665. So definitely a bit less from just selling two Strangles. But if I was still looking between $600 to $700 in total credit for one position, this definitely satisfies that. Moreover, the notional value of this position is half of what I just showed you previously with selling two Strangles, two contracts each. So again, that means with Pinterest trading at 76 bucks right now, the notional value on this Strangle is just 76 times 100, which gives you $7,600. So again, half the notional value and basically the same amount of credit, just a little bit less. So bottom line here, when you are looking to scale up your trade size, I would start first by scaling up using the deltas of the options you're selling. Just sell contracts with greater deltas, and therefore you'll take in greater credit. And then eventually, as your account size gets bigger and bigger, the next step would be to then scale up using the number of contracts, right? Because even if I sell the at the money straddle, which is the 75 strike call option and the 75 strike put option, the total amount of credit I could collect for putting on the straddle is going to be about $1,300 or so. And that still may not be enough credit if my account size is large enough. So in that case, what I can do is still come back out to the 90 strike call option and also the 70 strike put option, give myself some room for the stock to move, and now just sell two contracts each, two calls and two puts, and then go from there. So in summary here, when you are trying to scale up your positions with short naked options, start first by increasing the delta, and then after that, increase the number of contracts. And definitely also on a periodic basis, perhaps once a week, calculate the total notional value of all your positions put together. And I would say once the total notional value of all your positions becomes more than double your total account value, that's when tail risk is going to become a significant issue for you. So make sure to always keep that in check. And so that's going to do it for this video. I hope you enjoyed it. And please let me know your thoughts or if you've got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.